What if I told you that a single word repeated over and over again could be the difference between years of frustration and becoming a consistently profitable trader? Chances are you've heard this word thousands of times, but you probably never thought about it in the way that I'm about to explain. As a parent, there are two phases I never want to go back to: the potty training phase and the why phase. Yes, you know, the one where every single thing you immediately say is followed by a why, then you give an answer, and it's a why, then you answer again, and then a why. Now, I hate to admit this, but looking back, our kids actually might have been onto something. You see, about 100 years ago, Japanese inventor Sakichi Toyota, often referred to as the king of inventors, introduced a problem-solving technique called the 5 whys. It was built around the Kaizen philosophy, something I personally follow, of continuous improvement. And the idea is simple. If you want to create a lasting change, fixing the surface level problem isn't enough. Real long-term improvement comes from identifying the root cause of the issue and making your changes there. And in trading, this concept is absolutely massive. Because when your performance starts slipping, we all have the tendency to shift the blame. We blame the news, we blame the broker, we blame the market, we blame the strategy. You blame the dog, you blame the cat. You blame everything except for the real problem. And when you do that, it's like trying to fix a gushing wound with a tiny band-aid. It might cover it up temporarily, but it doesn't actually solve anything. So the purpose of the 5 whys is to dig beneath the surface, to identify not only how did that wound happen, but why it happened in the first place so that you can avoid putting yourself in that position again. So here's the process. You start by asking yourself, why did the problem occur? And then you take that answer and ask why. And then you take that answer and ask why again. And you keep going until you truly understand what is actually driving the problem, or until you can't come up with any other answers. Now, despite the name, you don't literally have to ask yourself why 5 times. Sometimes you'll find the answer after 3 questions, or sometimes it might take 6 or 7. Can't believe I just said that. Anyway, the goal isn't to hit the number 5. The goal is to keep digging until you can no longer find that meaningful answer. So let me give you a simple non-trading example before we hop onto the charts and I give you a trading example. We are currently in the middle of a heat wave here in the US. So I finally gave in and I decided to turn on the AC. Except there was one problem. When I hit that button, boop, nothing happened. So let's apply the 5 whys to that situation. Akil, why is it so incredibly hot in here? Well, because the AC isn't working. Well, why is the AC not working? Well, the AC is not working because the filter is clogged. Well, why is the filter clogged? Because I didn't change it. And why didn't you change it? Because I forgot. And why did you forget? Because I never actually put that reminder in my calendar. And you see, now we've found the real problem. The solution isn't just replacing the filter. That's a one-time fix, and then before you know it, I'll be in the same situation 6 months from now. The real solution digs deeper, and that is making sure that me, Akil, puts that reminder, a reoccurring reminder, in my calendar so that every 3 months, I'm not back in the same situation again. So let's head into the charts and look at a trading example. And this is actually a live trade that I'm in right now. So what you see in front of you is a trade that I'm actually in. The analysis is still on the chart from our live trading room this morning. And for you guys that are listening to the audio version only, I'm going to try to make this as clear as possible. But what we're looking at is a bearish Gartley pattern. And what has recently happened is that the pattern has been filled and price action. There's a really, really big green candle that jumped all the way up and held at the previous level of structure, so a structure high. Now, this specific candle actually broke past structure by, let's see how many pips we actually did that by about 20 pips, and it ended up closing below. So from a pure structural perspective, this is actually a positive sign for the bears, right? A break and close above structure would be a sign of a violation. A violation would lead us to predict that price is likely to go to the upside. If price is likely to go to the upside, we're probably going to be stopped out. So this is more of a rejection and hold. But Let's say that we are a trader that had our stop loss right above those highs, and as price spiked up, it hit our stop loss, took us out, and then let's say in the future it came back down and hit our would-be targets. How would we assess this situation? So the first question that I would want to ask is, well, Akil, why did this trade lose? And my answer would be, well, because price spiked up and hit my stop loss. Duh. Well, why did price hit your stop loss? Well, because my stop loss was probably a little bit too close to our previous level of structure. It didn't give the market enough breathing room, and well, it got me. This is something that newer traders have said thousands and thousands of times, and guess what? Professional traders know it, so stop putting your stop loss so close. Speaking of which, that goes to my next question. Okay, Akil, well, you said you didn't give it enough breathing room. Why did you put your stop loss so close? Well, because I put my stop loss so close because I didn't want it to be too big. Well, why didn't you want to have a bigger stop? Because a bigger stop might have meant that I would lose a lot more money. And why don't you want to lose a lot more money? Well, that's an easy answer. Because financially that hurts. When I lose money, it hurts, and I don't want to feel that type of pain. And you see, we've actually uncovered the real issue. The problem on the surface area is that my stop loss was too tight, right? But that's not the real lasting solution. The real lasting solution is that I am fearful, I am afraid of losing money. And although I may be able to make an adjustment the next time I have a trade like this, I'm still going to run into these bigger problems in different trading scenarios. They're just going to come in a little bit of a different looking way. So again, uncovering the real issue, it wasn't the strategy, it wasn't just bad luck. The real problem was that my position size was too large for me to comfortably accept the risk. Because I was afraid of losing more, I put my stop loss closer, and because I moved my stop loss closer, I put myself at a better chance of getting stopped out, which in this hypothetical example did happen. So now that we are aware of the root issue, let's talk about a solution. I've got two of them for a situation like this. One, how about I reduce my position size? I told you guys this a million times, but my mentor once told me that, Akil, when it comes to position sizing, you should trade so small that a win isn't life-changing and it doesn't really kind of make you super excited. And also that a win doesn't hurt that much, right? So what that does is it keeps you emotionally neutral. So one solution would be to reduce that position size. If I reduce my position size, I'm no longer going to feel that pain that's directly associated to me losing that specific amount of money. And because of that, I'm going to feel more comfortable putting my stop loss where it should be and not purposely having it tighter because I'm afraid of losing that money. Another solution could be changing your risk management approach, right? If you used a fixed percentage risk, then you're never going to have this problem. And what I mean by that is this. A fixed percentage risk means that you're risking the same percentage size of your account no matter what your stop loss is, right? So if your stop loss is 100 pips away, that 100 pips should be 1% of your account if you're using a 1% fixed risk. If your stop loss is 10 pips away, that 10 pips should be 1% of your account. So your position size is actually going to change, but your risk is going to be the same. So as a trader, if you are comfortable with 1% risk, if you're like, yeah, it doesn't bother me, I'm cool with it, then all of a sudden it doesn't matter where you have your stop loss. You don't have to have it tighter to avoid risk because your risk is going to be that 1% no matter where it's at on your chart. Problem solved. So if you want to consistently improve your trading, I highly recommend making this exercise a regular part of your post-trade review routine. That's that journaling part. And if you want to learn more habits that can help you become a better trader, check out this video next, 10 things that smart traders do.